Social Security, okay, this is a resource considered a tailwind factor, right? Different benefit levels depending on obviously what your earning history was. It's the highest 35 years. And what you actually get as a benefit is determined also by when you decide to take your benefits. You can start as early as age 62. And this used to be a lot more simple. Used to be everybody's full retirement age was age 65. But we're in a time right now where that's gradually increasing, where it's going to be 67 for everybody, right? And that depends on when you were born. So for me, I was born in this range, so I'm looking at age 66, okay? And what these last two columns show is what's the percentage of benefit reduction you take if you retire at age 62 versus waiting to your full retirement age, okay? Because the benefits are lower. And routinely, that's kind of a question that gets asked of somebody like me is, you know, I'm 62, should I start taking my benefits now? And there's a general principle in personal finance, really any finance, when you're talking about money. And one of the things they teach is called the time value of money. And the simple concept is more money sooner is better. Right? The more you can get sooner is better. So that's not only the amount of the money, but the time. So if you keep that kind of as a basic factor in your mind, you'd say, well, this is less money sooner. So what's the trade-off? Right? If I wait, I get a higher amount. Well, you've got to forego, say your full retirement age is 65. You're now 62. If you wait 3 years, you won't have a 20% reduction in your benefits. But you get the money for 3 years sooner, right? So having that money sooner, we can do some calculations and say, well, if I wait, at what point would I break even on waiting by giving up having this money sooner? And depending on your assumptions, it's like around 15 years. So if you're 62 and 15 is what, 77? So do you want to have more money over those years? With what's the average lifespan? You know, you got to live long enough to get ahead. So that's the factor. It's kind of like the default factor for most of us, the way we think is, why don't you take it at 62? But you got to look at, you know, how are you going to use that money? Do you need it? If it's going to make a significant difference in your peace of mind, your standard of living, your sense of security, and especially if you have health issues, don't wait. There's no benefit there.
But what investment would pay you 20%?
Well, that's 20. Yeah, that's a 20% reduction, and right, and that's part of what we're talking about. Is you're going to wait to be higher, and truth be told, if you wait to age 70, you can increase the benefits as well. You can delay, and the number in my mind is 5% increase. And I can't remember, I don't think that's annual, I think it's just total benefits are up 5%, but it's been a while since I've looked at it. It never makes sense, so if I don't use it, I don't keep it in here. But there was a strategy that people were using, was they'd start sooner, use the money to invest. If they did good on their investments, they could pay all the money back to Social Security and restart at a higher level. That's called milking the system, right? The system wasn't designed for that to happen. But quirk in the rules, somebody figured out, hey, there's no prohibition against this until now. It's no longer allowed. So does everybody kind of get the idea here? You can take a lesser amount at age 62, and maybe that makes sense for you. But you kind of need to look at the numbers and see how it fits and how it's going to impact your life. Whether or not it would make sense, you want to run the roulette wheel on, I'm going to live to 100, therefore I'm going to wait 3 or 4 years because I'm going to, do really well. Odds are, statistically, that wouldn't be true for all Americans because we don't live that long, right? Some key facts, and this goes to your question about Social Security. This was the benefit increases, and it's driven by cost of living number. In 2011, 10, and 9, obviously, well, no benefit increase for 2011. These are the maximum earnings you can receive and still get full Social Security benefits. Okay, and this is, you got to look at the first column here. If you're under full retirement age, there's one number. In the year of full retirement age, there's another number. And basically what it works like this. If you're under full retirement age, like say you're age 62 and you start drawing Social Security, you potentially could end up giving back $1 of benefits for every $2 of earnings. Now, once you reach full retirement age, they start giving you that money back that you forfeited. Okay, so it's not a total loss. But there is that factor, okay? In the year of full retirement age, before your birthday, you could end up giving back $1 of benefits for every $3 of earnings. And then once you hit full retirement age, you can earn all you want, and there's no give back. Maximum benefits in 2011 paid out is $2,346 a month. And the full retirement age is 66 years. Medicare premiums are, kind of tied into this. If you're eligible for Social Security, you're eligible for Medicare. So you would have no Part A premium, but you would have a Part B premium. Part A is hospitalization. Part B is go see the doctor. Okay? Hospital deductible, etc. A lot of detail here on taxes relative to Social Security. And this kind of goes to your question. The basic formula down here is adjusted gross income plus non-taxable interest plus half your Social Security benefits equal your combined income, which then determines how taxable your Social Security benefits might be. And the two benchmarks are either 50% of it's taxable or up to 85%, depending on how you fit into the circumstance. So that changes every year, kind of depending on these other factors. So are Social Security benefits taxable?
Yes.
Well, the typical CPA, CFP, enrolled agent answer is it depends, because that generally applies to everything, right? It depends, most likely. But if this is your only source of income, no. And state tax doesn't apply. So we're only talking federal here. California doesn't tax Social Security income. Move over to investments. What I'm trying to do here is kind of give you some key factors that go into figuring out how far you can stretch your resources, or how much in terms of resources you need to be able to generate an income, right? So depending on where you are in the financial life cycle and the kind of allocation you would have in your portfolio, meaning fixed income like savings accounts, CDs, bonds, versus equities, stocks, investing in by owning a piece of a company, and the blend of those two together, what kind of rate of return might you expect to earn on that portfolio over the long haul? you're not going to earn this amount every year. But when you look back and you do an average, you'd say, well, that's what my average rate of return was. But there were some lean years, and then there were some killer years, right? So usually when we're in financial independence with a portfolio in a range of 50-50, long-term rate of return about 7.5%. Okay, conservation, long haul 7%, distribution down into the 6s. Okay, if you want to increase your safety factor, you take a half percentage point off each of these numbers, or maybe a full, and use that as your planning number. And there's another concept in this business too, is safety comes at a cost. Right? I mean, that's just kind of a factor that's there. You can't have everything. We always have this conversation around what in financial terms we call nominal interest rates, meaning what's the top line rate printed on the paper, right? Your account says it's paying you 2%. Well, really what you're interested in is what's my real rate of return. And whenever an economist or financial person talks about real, they use REAL in front of something. Generally what they're talking about is something that's inflation adjusted. And that's what you really spend, is what your money will buy. And that's what real rates, or anything that's adjusted for inflation, is trying to get to. So that's really what we're interested in. And I have this conversation with my older clients fairly routinely, is invariably they complain about the low interest rate on the money that I want them to have in their savings account, because I know they could need money unexpectedly. And I tell them, the point of this money isn't the interest rate, the point of this money is your safety. It's safety trumps yield. Safety is more important than the yield. But at the same time, we get into this other conversation and say, you own your home or you're on a fixed interest rate, so we know what your housing cost is. And we know that housing costs are a huge driver in that cost of living formula. So I know that if I have a client in that circumstance, I don't have to be as concerned for their own personal inflation. They have some kind of health insurance, right? So their medical costs are contained to a certain degree. So even though top line inflation may be 2%, and they're getting 1% on their savings account, but their personal experience of inflation is less than that 2%. I'm thinking of one client in particular, drives a Prius, so gas prices, and she drives her Prius around town, right? Everybody knows what that one is, right? 40, 50 miles per gallon. So that's not a huge factor. She has a garden, so she grows her vegetables. It's like you're breaking even or making money in real terms on that really low interest rate. You just don't know it. And it's hard to convince people of that, because that's not the way we have the discussion routinely in the country, right? So those are other factors that kind of fit into some personalized planning that, you get a sense of you're going to be okay.